Hello everyone, this is a tutorial to show you how to use data analysis add-in in Excel, and in particular to finish your last part of the portfolio report 1. So you're interested in the variance-covariance matrix and the correlation matrix. The variance-covariance matrix is required as an input into the markets optimization models that we'll be using in our portfolio reports too. So eventually you will have to estimate it. However, for the purpose of the portfolio report 1, it is much better to analyze and to look at the correlation matrix. The reason for that is the variance and covariances, they're unit dependent and they do not normally conform to any specific range of values. They're unlimited from negative infinity to positive infinity. Correlation, however, is limited from -1 to 1, plus 1 being the situation where one stock is exactly mimicking another stock. Of course, you will never probably achieve this particular situation. -1 would simply say that the two stocks move exactly in the opposite direction, and the correlation of 0 would say that the two stocks, or the two stock returns, are independent of each other. Now, to perform the correlation estimation, we go into the data analysis add-in and select correlation. You will notice that the technique that I'm using here to get the correlation coefficient estimates are identically and the same as you would do with the covariance. The only reason is the correlation is the normalized to be from -1 to 1. So I'm going to select the correlation here, and my input range should be the block of stock returns that I've already estimated for the period that I decided to use in my portfolio. So the input range would be my 5 stocks in the portfolio. I'm going to select all of them for the full range of data available to me. And if you notice, I also highlighted and selected the labels with containing the names of my stocks. Okay, so this is where it finishes. Now, I do have labels in the first row, and the correlation matrix could be in the range in the current sheet, or you can create a new sheet and call it correlation matrix. Click OK. The benefit of including the labels in the first row is that they will automatically be inserted here. Now, additional tool in Excel that might prove quite handy is to do the conditional formatting and do some colors with it. So we know that large positive correlation coefficients would not necessarily be good in our portfolio because it will lessen our ability to diversify, and 0 or below 0 or close to 0 correlation would actually be more beneficial. So I'm going to use the inverse color coding, so high values, high positive values will be highlighted as red, and lower values will be highlighted as green. So I also don't need to see too many decimal points, and I'm going to format my numbers to be only with 2 decimal points. Now, the diagonal essentially says that Akita drilling with Akita drilling is correlated identically. So of course we would expect the correlation to be perfectly +1. Now this number is a bit redundant, so what I would do instead is replace this number with annualize the standard deviation for Akita drilling for the time period that you've selected. I think we've already estimated this before, and the annualized standard deviation for Akita was 36.17%. So I'm simply gonna insert it here. Now it pastes as the formula, and the formula link is lost, so instead of that I'm gonna paste it as value and number formatting. So 36.17% is the standard deviation of the Akita drilling for that particular period. You can do the rest for other stocks in your portfolio, and that should be the output of your last section of the portfolio report.